Hey there, Joe Massey with Castle and Cooke Mortgage. Have a great topic that we're going to be talking about today. Is it a good time to buy real estate? I talk to a lot of buyers, I talk to a lot of sellers, I talk to a lot of real estate agents, a lot of investors, and I see that a lot of people are feeling like this guy right here. So what are clients and investors stressed out about right now? Number one, high interest rates. Number two, no cash flow. Number three, it's too expensive to buy. I'm waiting for prices to come down. There will be a foreclosure boom. It just seems like a good time to wait, and there's just no deals out there. So let's dive in and talk about each one of these topics. So the first point I want to cover is a summary. So if you're an investor, number one, good news, housing is normalizing after two unprecedented unicorn years. Seasonality is coming back, which is a welcome sign. We're seeing prices rebound and buyers are active as housing is beginning to normalize. So how to coach yourself in this current market environment. If you're a first-time buyer, it might make sense to buy as soon as possible. Once interest rates go down, you're going to see that demand is really going to increase and prices are going to go up pretty rapidly. So if you buy now, you can always refinance later in the future, and we offer our free refinance voucher to allow you to refinance with no closing costs whenever interest rates go down in the future. If you're a trade-up buyer with an average to nice home, you're going to want to buy now for the same reasons as a first-time buyer. But what if you're an owner-occupant seller and you're not buying anything? You might want to wait. When interest rates go down, you're going to see demand increase really fast, and your market power and your selling advantage is going to increase. If you're a trade-up buyer with a below average home, you're probably going to want to wait. Subpar homes or homes that have some damage or deferred maintenance don't sell very easily in this market. But for what we're talking about today, if you're an investor buyer, it really makes sense to buy now and refinance later. Or if you're an investor trade-up, like doing a 1031 exchange, also makes sense to buy now and refi later. But don't just take my word for it. Let's dive in and look at the stats on why this makes sense for investors. There is likely going to be more buyer demand than seller supply, which is going to point to significantly decreasing inventory and steady prices. When rates finally do go down, we think there's going to be a significant supply and demand imbalance. There's going to be too many buyers and not enough sellers. So 18% of people say they're likely to buy a home in the next 6 months, yet 16% of homeowners say they are likely to sell in the next 6 months. So even right now, with depressed demand because of high interest rates, there's more buyers than there are sellers. So what that means when interest rates do go down, there's going to be increasing appreciation when rates decrease. Now, let's talk a little bit about high interest rates. Mortgage interest rates increased in 2022, but are historically still very, very attractive. So let's look at the average 30-year interest rate by decade. Over the last 50 years, the average has been 7.76 and currently at 7.57, which is below this 30-year average, but it still feels very high because we're accustomed to this 4% or 4.09 we've had over the last decade. But that's not the whole story. Let's take a look at what's happened over the last 40 years. Someone born in 1980 is now 43 years old, and they're in their peak investing years. The average interest rate over their lifetime is 7.51%. All right. And we're currently at 7.57. So we might say, hey, that's average. They should be really happy. But the average interest rate over their adult memory, they turned 18 right here in the late 90s. And they feel like average interest rates are this 5.23%. Therefore, most investors feel like rates should be right at this 5.23%. So have rates gone up from that level? Yeah, they sure have. So it does feel very high. Here's an important point. I've known people that bought properties back here in the 80s that did really well. I've known people that bought properties in the 90s that did really well. I know people that have bought properties in the 2000s that did really well. Even people that bought in the 2010s and 2020s that have done really well. What you're going to learn is owning real estate and making money and building wealth off of owning real estate is oftentimes independent of interest rates. And that's another point we're going to talk about today. So what about this? I'm going to wait for interest rates to come down. Let's look back at some of the interest rate projections from August of 2022, just over a year ago. The experts and economists anticipate that mortgage rates are going to decline over the next year. So they think in third quarter of 2023, interest rates are going to be back down to 4.86. We're currently at 7.57. So these projections were low by more than 2.5%. Well, what do these projections say right now? They're still predicting interest rates of 6.10 for this quarter. All right. And what they're showing is interest rates trending down through the next year. Now, we haven't experienced that, right? We're still seeing these projections are low by 1.5%. So if we do have this trending lower rate over the next year, this 5.5% plus 1.47 is still going to have rates right around 7%. So if you're waiting for interest rates to come down, you might be waiting for a long time. There are fewer and fewer indicators that interest rates are going to come down in the near future. The Federal Reserve's campaign to tame inflation and engineer a soft landing appears to be working. So investor hopes of reduced interest rates late this year or early next year are not likely to come true. Now, what about cash flow? This is a concern that I hear from a lot of investors. They say, Joe, there's just no cash flow in the market right now. Well, let's walk through a deal in 2019 and tell me if you wish you could have bought this deal in 2019. So purchase price of $182,000. They put 25% down and they spent a total of $48,000 after repairs on this property. So this property is generating $19,000 a year in annual rental income, minus expenses for property management, repairs and maintenance, homeowners association dues, property taxes, property insurance. This has a net operating income of $12,000 per year. But what's the biggest expense? That mortgage. That was at a super low rate. I think this was around 4, maybe 5%. So annual cash flow, $3,927. Pretty good deal, right? This property is generating some money every single month. We're going to plug that cash flow into our return on investment quadrant. And then we're also going to factor in what's the depreciation on this property. How much does the debt go down every single year? And what's the appreciation? That's going to give us this total return of $17,480. Now divide that into this $48,000 invested. That is a 36.3% return. Pretty solid deal, wouldn't you say? But let's look at what this came with. Number one, it came with a 4.5% interest rate. Good cash flow, making $350 a month, really positive, but it came with some negatives like high competition. There were 7 other offers and the investor paid $10,000 above the list price and $15,000 above the appraisal. So the value of this property was actually $167,000. Yet they paid $182,000, meaning the investor was out $15,000 in equity on day one. So that cash flow is really good at $3,900 a year, but it takes 4 years for the cash flow to pay back the premium that the investor paid for the property. How does that impact that cash on cash return? Well, you're actually a little bit upside down, and it takes time for that appreciation to build up to what you paid for the property. So you actually only got a 3.5% return on that property. So let's take a look at this property over 6 years. What do you get? Of course, increased rents. Let's assume 4% increase per year, good cash flow, and positive cash flow on day one. However, negative equity on day number one and a total investment of $48,000. So your total return in cash flow, equity, debt reduction, and tax benefits over 6 years, $89,708. That's an 86% return in 6 years, annualized to 14.3% per year. Pretty solid investment, right? So if you're sitting at home and you're watching this and you think, boy, I really wish I could go back and buy one of these in 2019, I get it. This cash flow is really, really good. But let's compare to a property that you might purchase today. This is a property, real property right now in 2023, purchased for $210,000. This particular investor put 25% down. They were able to get some seller concessions. So their net closing costs were really, really minimal, and they had no repairs needed. So they invested $53,000 on this property. Now rents have gone up a pretty decent amount, $21,000 per year, but they've got some expenses for property management, repairs, maintenance, homeowners association dues have gone up, property taxes, and property insurance. So this property has a net operating income of $10,000 per year, But what is the biggest expense? That mortgage. That mortgage payment has gone up significantly, which now has us in a position of negative cash flow. So let's factor in this negative cash flow into our return on investment quadrant. We're still getting depreciation, we're still getting debt reduction, and this property is appreciating. So we're getting a return of $11,000 per year on this $53,000 investment is a 21.6% return. So initially, I think I would really like to have that property in 2019 because it's getting a better return, it's getting better cash flow. But there's more to the story than that. What did this deal come with in 2023? Number one, a 7.25% rate, much higher rate. Negative cash flow, losing $220 a month. But what are the good things it came with? Low competition. There was only one other offer, and this investor paid $10,000 below list price, and the property appraised $30,000 greater than what they paid for it. So they paid $30,000 below the appraised value. So value of $240,000 and a price of $210 means the investor was up $30,000 in equity on day one. That equity gain on day one pays for 11 years of this negative cash flow of $2,655. So let's factor that into the return on investment. What does that do for us? With all that appreciation gained in year one, $41,000 of gain, 78% return on investment in year number one. But let's look at the long term for this property. So same property, same cash flow statement, but I've taken this out to year number 6. So what happens here? You see that rents have gone up. Expenses have gone up, of course, right? Property taxes go up, insurance goes up, repairs, maintenance, etc. But what did not go up? The mortgage payment. That mortgage payment remained exactly the same. And now you're generating a whopping $10 a year in cash flow, not a lot of money, but you have achieved positive cash flow after 6 years. And how much is this property worth? Well, you've built $173,000 in equity. So what does that mean you're getting from this property in 6 years? Number one, increased rents, property appreciation, let's assume 5% per year, and you're finally breaking even in year 6. What was your total negative cash flow through 6 years? Negative $8,200 that you had to invest into the property over that 6-year period. So you invested $53,000 on day one, $8,200 over the course of 6 years for a $61,000 total investment, which gives you a total return in equity, debt reduction, and tax benefits of $133,000. That is a 117% return in 6 years, or 19.5% per year. So compare that back with the first scenario. You're actually getting a better return buying a property today because there's less competition. You don't have to pay a premium for that property. But does cash flow matter, right? You're not getting any cash flow. So does it matter? Maybe cash flow does matter to you. All right. But do you like a 117% return? I know that I do, and I know that it's available. Here's how I know it's available. I'm the investor that bought this property in 2017. I'm also the investor that bought this property in 2023. So I wanted to show you some real scenarios, and then you can decide, does cash flow matter to you? If it does, now might not be a good time to buy a property, but if you like 117% return, now maybe is a good time to buy property. Now, I've heard this a lot. It's too expensive to buy. There was a great article that came out from Redfin in March of this year, and they compared the average rents to the average mortgage payment in 50 different markets. And they found that in most markets, it's more expensive to buy than it is to own a home. And let's just look at Denver. The estimated median monthly mortgage cost is $4,500. The estimated median rent is $2,800, meaning it costs $1,663 more to own a home than it does to rent in Denver. Therefore, you should just rent for the rest of your life because it's cheaper, right? Well, there's a little more to the story than that. So let's take a little bit of a deeper dive in this. With high rates and expensive homes, is it really cheaper to rent? So I took a really deep dive in a separate video where we dove in and looked at renting over 5 years versus buying a home versus buying a condo over the next 5 years. And these are the conclusions. If you rent for the next 5 years, you're going to pay $184,000 based on that median rent, and you are going to generate precisely $0 of equity and $0 of increase in your net worth. What if you buy a single family home? Yeah, it does cost more money. It costs $209,000 in mortgage payments. Now that is net of your tax benefits because you do get some tax benefits. But let's not forget, you have built up $237,000 in equity. So it does cost you $580 more per month, but you build $237,000 in equity versus $0. What if you buy a condo or townhome, which is pretty similar to an apartment that you might rent? Well, what do you know? It's actually cheaper. You would pay $157,000 over the next 5 years, and you will build up $160,000 in equity. So you save $278 per month as compared to renting, and you build $160,000 more in equity. So does it mean it's cheaper to rent and you should just rent for the rest of your life? Maybe, maybe not. It really is up to you and your personal situation. But if you want to take a real deep dive into this, check out our website, loansbyjmassey.com. We do a full 20-minute analysis on this, and this will really help you determine, is it better for you to rent or is it better for you to buy? Now, let's talk about Ascent of the renters. This is something that's really important for investors. There's a strong relationship between home price and what percentage of the population rents versus owns. More expensive cities have a higher percentage of renter households. So let's look at Fort Wayne, Indiana, and rural Iowa down here. All right. Home prices are below $200,000, and you see that greater than 60% of people own a home. Well, here we are in Denver. As of 2006, greater than 55% of people owned a home when our average price was about $240,000. Well, let's look over here at San Francisco, one of our favorite, most expensive markets. Median home price, $1.3 million, and only about 40% or 45% of people actually own a home. So what you see is as home prices go up, you see more people renting. Well, why does that matter for us? Here we are in Denver, 2016. Home prices have increased. What did that do to home ownership? Home ownership rates went down, more renters. Where are we currently? 2023. Home prices are up almost or even greater than $800,000. What is that doing? We are now a renter-based market, meaning there is more people that rent than there are that buy. What does this mean for you? If you have the means to become a homeowner, if you have the means to buy a property, you should do that because it's going to become more and more unrealistic to save up for a down payment. If you have the means to buy right now, you should buy. If you're a first-time buyer, you should buy. If you're an investor, you should buy, because as we continue on this trajectory, there's going to be more and more renters and fewer homeowners. And you don't want to get stuck in that trap where you can't afford to buy a property, whether it's a primary residence or whether it's an investment property. And if you're buying as an investment, this is good for you because this is going to lead to increased rents in the future. Now, there is less first-time homebuyer and less investor competition right now. So this chart on the left shows investment property purchasers and what they've been up to for the last 20 years. You see there was a peak right in the middle of 2021 where investor purchases were at the highest level they've ever been at. And then as interest rates increase, what happens? It falls off of a cliff, that there's a lot less investors in the market, but they have been coming back over the last 2 quarters. So what does that mean for you? The exit of many large-scale investors has opened up the market for mom and pop investors to step into this void. But what you've got to understand, there's going to be less cash flow, but you're still going to be getting debt reduction, appreciation, and tax benefits. So still lots of really good reasons to purchase properties, and this lower competition means that you can get deals, which we touched on a few slides ago. What about rents? You're buying with negative cash flow right now. Does that mean you're going to have negative cash flow forever? No, rents have been increasing for the last 20 plus years and are projected to increase for the next 5, 10, 15, 20 years. But looking at this increased rents, you're going to be making more top line money, more revenue because rents go up. But what doesn't change? The mortgage payment. The largest expense stays flat. So as revenue goes up, your biggest expense stays flat. Guess what? You're not going to be in a negative cash flow position forever. Now, a lot of folks are saying, Joe, I'm waiting for prices to come down. Okay, I understand that. Let's take a look at what's happened here. So in the first quarter of 2023 and the second quarter of 2023, we did see in the Denver market a 3% year over year reduction in home prices. But what happened in third quarter? We've actually seen prices begin to bounce back. And let's look nationwide. This is the month over month price change from the Case-Shiller Index. There's also indexes from Zillow, indexes from the Mortgage Bankers Association, indexes from Fannie Mae, and they all show these exact same trends. So home prices were going up every single month up until June of 2022. And then you saw home prices declining on a month over month basis. And then what happened in February of 2023? Home prices began coming back up, which is exactly what we see here in the Denver market. All right. So you saw there was a dip in prices and now prices are going back up. So if you're waiting for prices to come down, you already missed the boat. That already happened right here for about that 6-month period. Now prices are on their way back up. So it's important to understand we are likely past the bottom of any price drops. And don't just take my word for it. Don't just take the Case-Shiller Index word for it. There was a great article that came out from CoreLogic back in August that in the month of June, home price growth was weak, but appreciation is probably bottoming out, meaning that we've hit the bottom of any depreciation in the market and prices are going to continue to go up, which is exactly what we saw on that chart. Now, other folks that are saying, I'm waiting for prices to come down. Let's talk about the supply side. So this is one of my favorite charts. It shows the average number of new homes constructed in the United States all the way back to 1970. So the average number of units every year is 1 million homes on average. And you see right here was the global financial crisis or the Great Depression of 2008. And home construction falls off a cliff. And we see this really low amount of home construction here for the last 14 years. This area under the curve here, this is 4.5 million homes that did not get built over the last 15 years, meaning we are 4.5 million homes below average that we need to keep up with population growth and demand. So what happens when that occurs? There's not enough homes. There's too many people. Prices are going to continue to go up. And the last one, let's talk about the demand side. We have a large demographic cohort that's in their prime years to be first-time buyers. So the millennials are the largest generation, even larger than the baby boomers. And these folks are ranging in age from 25 to 39, and they are in their peak home buying years. So in the last slide we saw we're not building enough homes. And on this slide we see we have a lot of home buyers coming to the market. What does that mean for prices? Likely to keep going up. Now, I'm still waiting for prices to go down. I'm not convinced yet. This is the original forecast for 2023 from the Mortgage Bankers Association, from Fannie Mae, Morgan Stanley, AEI, Zillow, Wells Fargo, Goldman Sachs, and home buyers. What do these all see? Massive price declines. What have they all revised their current forecast to? Flat to maybe increasing in some markets. All right. So it's important. A year ago, everybody was very, very pessimistic about the market. What are they seeing now? We've gone through the dip and now we're on our way back up. So it might be a really good time to buy because prices are not likely to come down any further. In conclusion on this slide, if you're waiting for prices to come down, you're too late. Prices already did decline and now they're on the way back up. Supply, one of my favorite charts we looked at, we are short by 4.5 million homes over the past 15 years, and there is no sign of new construction making up this shortfall. We're going to be supply constrained for likely the next 10 plus years or more, which is going to lead to increased prices on resale homes. And demand, we touched on this. Millennials are the largest home buying segment and they are in their peak home buying years. Demand is going to outweigh already really tight supply for a number of years. So today, not tomorrow, today is likely the cheapest that homes are going to be in the next 10 plus years. So should you buy today? Might make sense. But don't take my word for it. All right, this is from Andy Walden. He is the VP of Enterprise Research with Black Knight. This is a quote from a couple weeks ago. There is no doubt that the housing market has reignited from a home price perspective. Firming prices have now fully erased the price pullback we tracked through the last half of 2022 and lifted the seasonally adjusted Black Knight Home Price Index to a new record high in May. What does that mean? Home prices are going up. They are becoming more and more valuable. There's going to be a foreclosure boom. This is one of my favorites. I hear people talk about this a lot. Well, let's talk about what leads to a foreclosure boom. The number one thing is lending standards. So this chart is the Mortgage Credit Availability Index, and it peaked in about 2006 at a metric of 868. That means it's really easy to get a loan when that index is so high. Now, as it comes down, what you see, these are very conservative standards, and this green line increases until COVID right here, and then it becomes more and more difficult to get a loan. And currently, it is more difficult and lending standards are tighter than any time in the last 20 years. That means everybody that we give a new loan to, we have to verify their credit. We have to verify they can make the payments. We have to verify their down payment. You have to be really well qualified to qualify for a loan right now. So what does that mean for foreclosures? Everybody that gets a new loan has the ability to repay it. We're not just giving out loans to anybody and anybody's dog like we were back here. This is an indication of a housing bubble. This is not. And let's talk a little bit about delinquencies, because a lot of people say, well, Joe, housing prices are increasing so fast, there has to be a foreclosure boom. So delinquencies are a leading indicator. This is a chart that shows the national delinquency rate, which peaked back here at 11% back, again, during the global financial crisis or the Great Depression back in 2008, 9, and 10. And currently, we are at the 2.92% delinquency rate, which is the lowest over the last 20 years. That means that everyone that has a mortgage is currently paying it, with the exception of 2.9% of people. That is not enough people missing payments to cause a foreclosure boom. And even if all these delinquencies came on the market tomorrow, we're currently at 1.9 months of inventory. This would move us to 2.3 months of inventory. It would be just a drop in the bucket on inventory. And let's look at the headlines that you're going to see. I saw this one recently. There's been an increase in foreclosure activity of 252%. All right. Well, let's not forget, during the COVID years, really difficult to foreclose. There was only 65,000 foreclosures nationwide in 2021. How many were there in 2022? 164,000. That's a 252% increase. Holy cow. The world must be coming to an end. This is not a foreclosure boom, guys. This, 2010, this was a foreclosure boom. This is just a drop in the bucket compared to the foreclosure boom that we saw in 8, 9, and 10. So yes, there's been an increase, but it is not enough to move the needle. It is not enough to cause prices to go down. The next important point about a foreclosure boom is looking at equity. All right, if you've got a lot of equity in your home and you fall behind on the mortgage payment, what are you going to do? You're going to call your real estate agent and you're going to say, hey, Mr. and Mrs. Real Estate Agent, I'm having trouble making my payments. I need to sell my home because I need to get this equity, this $50,000, $100,000, $200,000 out of the home. But if you're upside down on the home, that's when a foreclosure is much more likely. So again, back to that global financial crisis, the Great Recession, 28% of people in the United States were upside down on their home, meaning they owed more on the mortgage than the home was worth. Where are we at currently? 0.4%. 0.4% of homes are upside down. And even if we were to have a 5, 10, or 15% price decline, we would only have 3.7% of homes in the United States that would be upside down and likely to go into foreclosure. All right. So if you've got equity, you fail to make your payments, sure, you might go to foreclosure, put your head in the sand and lose your home, but most people aren't going to do that. So this is, again, just a reminder, when there's a ton of equity, you're not going to see a ton of foreclosures. And the economic environment right now is much different than before the 2007 crash. So a lot of people think there's a housing price crash coming. Well, let's look at it. Job cuts over the last housing cycle, 8 million. Current housing cycle, very few job cuts. We're actually adding jobs. Subprime loans were very, very prevalent. That's what we looked at earlier with loose lending standards. There are virtually no subprime loans out there. And how much home construction? We were overbuilt prior to 2008 and 9. Now we are underbuilt. We're not building nearly enough homes. And mortgage delinquency at 10%. We're currently at 3.6 according to this metric. Really, really low delinquency indicates there is not going to be a foreclosure boom. And let's compare at that time, 4.6% of homes in foreclosure to 0.6. There is not going to be a price crash coming because of foreclosures, guys. So if you're hoping for a foreclosure boom to open up opportunities for you to buy foreclosures and get deals on a property, I don't think that's going to be a good strategy for you. So what happens if I wait? Let's say you buy a property today and you pay $400,000 for it. You put 25% down. You get an investor interest rate of 8.25%, and you have that payment of $2,253. But you say, you know what, Joe? I really want to wait for interest rates to go down. Well, when interest rates go down, you're going to get appreciation. Let's assume that prices have gone up by 3%, up to $412,000. You're also going to have to make a higher down payment because you're still doing 25% down. But if interest rates go down, buyer demand is going to increase and you might have to pay above asking price. So now you're investing $123,000 on the same home. But rates have gone down, hopefully. So let's say you get that investor interest rate of 6.5%. That's going to give you a lower monthly payment of $1,953. So right now you're saying, you know what, Joe, I should definitely wait because I'm going to save $300 a month. Well, let's double check this. You've got to pay $23,000 more for the property. That means with $300 a month of savings, it takes 6.5 years of that monthly savings to pay you back for that increased investment of $23,000. What if you were to buy today and refinance in 12 months? Again, let's say hopefully rates go down to 6.5%. And don't forget, you have your free refinance voucher when you work with us. So now this payment in a year is going to go down to $1,896, but you've only invested $100 rather than that $123,000. So you're getting an even lower payment by buying today, negotiating on the price today. Yes, I understand you're going to pay a little bit of a higher interest rate, but in the future, you're going to have an even lower payment versus waiting and hoping that rates go down and paying this premium above ask and a higher down payment. The cost of waiting, roughly $45,000 if you wait 12 months. That's a pretty expensive cost to wait for interest rates to go down. So what are the big benefits of the current market? Big benefits, number one, you can negotiate for seller-paid closing costs. You can negotiate on price. You have sellers that are willing to make repairs. You can pay below the asking price. You don't have to waive your inspection. You don't have to waive your appraisal. Much less competition, likely increased rents in the future, and likely increased appreciation. But there's some downsides. What are the downsides in the current market? Yes, you have higher rates and you have less immediate cash flow. So is it a good time to buy? Let's go back to all those things that investors are stressed out about. High rates. I completely get it. I think buy now and refinance later. No cash flow. But are there other benefits to owning real estate? Yes, there absolutely are. It's too expensive to buy. I think it's too expensive not to buy. We looked at the cost of waiting 12 months. I'm waiting for prices to come down. Too late. Prices already did come down, and now they're going back up. There's going to be a foreclosure boom. Not likely to happen, guys. There is not nearly enough delinquencies and not nearly enough homes upside down. And it just seems like a good time to wait. I understand that. Things can be uncertain. If you decide to wait right now, it may cost you as much as $45,000. So is it a good time to buy? I say yes. Now, that doesn't mean that you should just haphazardly run out and purchase a property. You want to make sure that it's the right time for you. You want to make sure it's the right property for you. You want to make sure that it makes sense for you to buy. I think the market conditions say yes, and I wanted to take a really balanced approach in this presentation, but tell me what you think. If you agree, disagree, put your comments down below, give me a call, email me, send me a text. I'd love to chat and see what you think. What else can we do to help? Here at Castle & Cooke Mortgage, we offer conventional loans, FHA, VA, USDA, jumbo loans, investment cash flow loans. We can help you purchase property, refinance properties you already own. We can help with primary residence, second homes, investment properties, home equity lines of credit, even fixed rate second mortgages, and all of the benefits that we offer. We have our 8-day closing service. Our average time frame to clear to close is 21 days. Our 100% pre-approval track record. If we give you a pre-approval, that loan will close. For agents out there, we've got our set it and forget it database through HomeBot. We help you with e-flyers, websites, and of course our classes in person or like this one online. If you want to learn more, please remember to follow us on Facebook, Instagram, LinkedIn, TikTok. You can download our mortgage calculator by scanning the QR code right there, or call or email. My number is 303-809-7769. Would love to chat with you anytime. Thanks so much, guys, and we'll talk to you soon.